Investing in the stock market via equity mutual funds has been one of the most popular ways to grow your money in India. These funds have given investors good returns over a period of time. You own a small slice of every company through the fund, you accumulate units over the years, the returns compound. But after a certain point, just being in mutual funds might not be enough for what you're trying to do. That is why there are three investment products which very few of you might be aware of, but most people in India have never heard of. They are all properly regulated by SEBI. So this is not a 21 din mein paisa double scheme. While one of them is very new, the other two have been around for more than a decade and they can be tough to understand at first. By the end of this video, you will know exactly what all three of them are, how they actually work, and the ideal situation where each one makes sense for you. And if you watch till the end, I have something specific for you. Stick around. If you have already invested in mutual funds or real estate, if you have some gold or fixed deposits, and you have surplus capital you want to put somewhere more strategic, this video is for you. Let's get into the three investment products: SIF, PMS, and AIF. Let me start with what each one actually is, beginning with the newest. SIF stands for Specialized Investment Fund, a brand new vehicle introduced by SEBI in April 2025. Minimum ticket size is 10 lakh rupees. It is regulated under the mutual fund framework, which means transparency, daily NAV, and SEBI supervision. The key difference from a regular mutual fund is that SIF can use long-short strategies and derivatives. Up to a maximum of 25% of its net assets can be invested into unhedged derivative positions. Mutual funds cannot do this. Moving on to the next one. PMS stands for Portfolio Management Service. It is the oldest of the three. It has been around since 1993. Minimum investment is rupees 50 lakhs. Now, here is where it gets different. Your money is not pooled with other investors. You own the actual stock in your own demat account and in your own name. A professional fund manager runs the portfolio, but the holdings are yours. The industry today manages over 8 lakh crore of rupees for individual investors with over 500 SEBI registered managers. Big names here are ICICI, 361, Inam, Motilal, Nippon, etc. And the last one, AIF. AIF stands for Alternative Investment Fund. SEBI introduced the AIF regulations in 2012, creating the formal regulatory framework for alternative investment funds in India. Minimum ticket size of investment here is rupees 1 crore, the biggest of the three. There are three subcategories in AIF, each doing something very different. The industry today has over 15 lakh crore of rupees in cumulative commitments, which include both institutional and non-institutional commitments. Around 30 to 40% of it is coming from HNIs and the family offices, and the rest is from institutional. Now that you know what they are, let me show you how each one actually works. SIFs work under the mutual fund framework. You get daily NAV, SEBI supervision, and transparent reporting. SIFs can be categorized into three different types: equity-oriented, which can take long, short, and unhedged positions; debt-oriented, which can invest into interest rate derivatives; and hybrid, which actively allocates between equity and debt. One catch: each AMC can only run one strategy per category, so your choice is limited. And liquidity is daily or weekly, depending on which type of SIF you choose. PMS works in three different ways. Discretionary PMS: the fund manager takes every buy and sell decision, the most common. Non-discretionary: the manager advises, you approve each trade. And the last one, advisory: the manager only gives advice, you execute yourself. Unlike a SIF or a mutual fund, in PMS, your money is not pooled. The stocks sit in your own demat account in your name. So you can ask the manager to exclude specific sectors or specific stocks if you want. One catch most people miss: every time the manager buys or sells in your portfolio, it is a taxable event for you, even if you did not authorize the specific trade. Now, AIF works on a completely different model. AIF is a privately pooled vehicle. The fund collects money from sophisticated investors and deploys it into things beyond stocks and bonds. There are three categories of AIFs, each doing a very different job. Category 1 invests in venture capital, infrastructure, SME companies, government-backed investments, etc. 7 to 10 years is the investment horizon and it's fully illiquid. Category 2 invests in private equity, real estate, private credit, and pre-IPO investments, etc. This is the biggest category in AIF with around 70% commitment. 5 to 7 years is the usual investment horizon, and again, it's fully illiquid. Category 3 includes long only equity funds, long short equity funds, hedge fund strategies, etc. This is the only AIF category that can take real short positions and use leverage. Also, these are open or interval based liquidity funds. Note that the investment commitments in the above funds can happen on a drawdown basis, meaning if you commit 1 crore, which is a minimum amount, you start with paying around 10 to 20% and then pay up the balance over a period of time as and when the investment manager will call for the amount. Now that you know what they are and how they work, the next question is the one that actually matters. Which one is right for you? Let me walk through the ideal situation for each. SIFs make sense if you have 10 lakh rupees and above of surplus capital that you want to deploy beyond mutual funds. If you want sophistication, if you want long short strategies, or if you want derivatives, and if you accept daily or weekly liquidity. Given SIFs are just less than 8 months old, do not decide based on the last 3 to 6 months returns. Decide on a product based on your risk profile, equity, hybrid or debt, whatever suits you. It's difficult to give an indication of the broad range of returns, but one can expect around 7 to 15% returns over a 3-year period. PMS makes sense if you have 50 lakh rupees and above of surplus capital you want managed actively. You want a stock level portfolio in your demat, not pooled with others. You want a concentrated portfolio with a potential to deliver higher return with higher volatility than a highly diversified mutual fund scheme. Or you accept that every churn is a taxable event for you. The most critical part you can do here is the work of selecting a good fund manager. Performance varies widely across the 500 plus registered managers. So select a wrong manager and the maths fall apart. Broadly, you can expect returns between 12 to 20% over a 5-year period. AIF makes sense if you have rupees 1 crore and above. Choose category 1 if you want venture capital funds, infrastructure funds, or SME funds. If you have high risk tolerance and you are comfortable locking your capital for 7 to 10 years. Choose category 2 if you want exposure to private equity, real estate, private credit funds, and you have 5 to 7 year investment horizon. Choose category 3 if you want long short funds, listed equities, or hedge funds. Some of the funds may have lower correlation to the market. Just accept the fund level tax drag in exchange. Broadly, you can expect returns between 15 to 25% in these categories. Now, let's finally move to the taxation. PMS, AIF, and SIFs are taxed differently, mainly on capital gains, dividends, and fund structure. PMS and equity-oriented SIFs broadly follow equity taxation with 20% short-term capital gains tax and 12.5% long-term capital gains tax. AIF category 1 and 2 follow a pass-through structure, meaning taxation happens at the investor level. Dividends and interest income from these investments are usually taxed as per the investor's income tax slab. For NRIs, TDS provisions may apply, especially in AIFs and capital gain taxation. Now, most important for category 3 AIF fund, the taxation is at the fund level. The fund settles all tax liabilities before calculating your final payouts. Taxed at the maximum marginal rate of 39%. As per the new regime and 42.74% as per the old regime. Now, as promised at the start, here is what I have for you. If you have watched till here, it is probably for one of the 2 reasons. First, you already hold a meaningful portfolio in mutual funds and you want to understand better some of the investments I discussed in this video. And second, you want to diversify what you have, or your relationship manager has already pitched one of these to you and you're gathering information before you sign up. If you identify with either of the above, I would be happy to offer you a complimentary portfolio review. Over 2 decades of working closely with HNI investors has taught me that portfolio discussions do not always require drastic changes. In many cases, reviewing asset allocation, fund overlap, costs, risk profile, and alignment with financial goals can often highlight opportunities for better portfolio outcomes. We will go through what you currently hold, understand the rationale behind your investments, and discuss observations and practical considerations for your portfolio. No fees, no obligations, just an honest experience perspective. The first link in the description goes straight to my calendar. Click it and let's talk. If you found this video valuable, hit subscribe. I'm Kishan. See you in the next one.